Stocks swing between gains and losses and amid fresh economic and geopolitical uncertainties. And after a big rally already, metals and utilities lead gains while realty and IT drag.
Metals perk up after China's central bank chief points to a 50 basis points cut in the reserve ratio and a cut in interest rates. He also promises lower rates for mortgages, even as reports suggest a recapitalization of banks is likely.
MobiKwik gets SEBI's nod for a 700 crore rupee IPO, while NTPC Green Energy readies for a likely November offer. Meanwhile, two of the three IPO listings today, Northern Arc Capital and Arcade Developers, deliver hefty gains.
A SEBI study from FY22 to FY24 reveals that 9 out of 10 individual F&O traders lost money, with their cumulative losses amounting to 1.8 lakh crore rupees during the period. Algo firms cornered most of the F&O trading profit. Hello and welcome to Halftime Report. I'm Ekta Batra and with me is Manglam Malu. Well, today is turning out to be a day where we are just about consolidating in terms of the indices. But if you look deeper, the Nifty is very close to those 26,000 levels. So nothing really to complain about at this point in time, just about biding time around those levels before we probably get to those levels on a decisive basis. But stock-specific action continues to be in focus. So just want to point out stocks such as AstraZeneca as well as Ipca are at fresh 52-week highs today from the pharmaceutical sales space. And separately, we've seen some good listings coming in from the likes of Northern Arc as well as Arcade Developers. So both those stocks are buzzing in today's trading session. But nonetheless, no complaints, Manglam. It seems as though we're just on our journey to 26,000.
Absolutely. It's not a question of if, but it's more of when. And a lot of stocks are doing a lot better as well, despite, the broader market or the market breadth showing signs of consolidation, even as the frontline indices are slightly below the flat line. We do have a bunch of these stocks which are doing extremely well. The metal stocks, of course, because of some boost coming in from China. But keep an eye out on, Arvind Smart Spaces up around 10% at a fresh 52-week high for that stock. Sapphire is the other one, which is up around 11%. At one point was up around 11%. Now sitting with gains of about 9% as well. We are seeing some traction in names like Godavari Power Ispat. We have Everready, which is higher by about 6.5% as well. The only, real accident in today's trading session on the way down is IEX. So just keep an eye out on that stock. And barring that, there is just consolidation at higher levels itself. So good time to get in, a call on the way forward for the markets. We have Christy Mathai, who's the fund manager, Equity Quantum AMC, joining in to give her view on the market itself. Christy, what's your sense here? I mean, how do you go about the way, it's positioned right now? And on the one hand, people say that there is still the growth opportunity, but on the other, there is valuation as well. So given your view on the market right now, how are you positioning yourself?
Thanks, Manglam, for having me. So clearly, we run a value strategy and value portfolio here at Quantum. So we are, to the latter half of what you said, we are concerned about the valuations that are broadly exhibited in the market. And I think that continues to be a key factor that kind of stops from incrementally adding so much to this market at this point in time. So the key bets for us currently looks mostly in the financial space. So roughly 40% of our portfolio is into the broader financials, which is roughly 25% into the banks, and especially the private sector banks. And that is the only place where we think there is still value that can come through if you're taking a slightly longer term the thought process. IT remains another key bet, but here we are watching carefully in terms of management commentary and what's developing in US. Broadly, the other portion of the market, in our view, continues to be overvalued, and we are largely staying away or trimming our positions in these pockets.
Okay, all right. In particular for IT, what are you watching out for when it comes to the management commentary, and what's your expectation from the Q2 numbers?
Right. So IT, we have seen, at least in the past few years, so bulk of the discretionary consumption that got started post, the COVID, the wave, what we saw. So there is fair bit of cancellation in terms of a lot of projects. And incrementally what we're seeing, a lot of companies reporting good order books, the deal wins, but because of these discretionary consumption being cut down, there is, that is not, the whole is not really resulting in large revenue growth for most of these companies. So incrementally, we think bulk of these discretionary cuts are, behind. A lot of it, the pace of cut may be a bit slow. And from here on, we think that, when we look at some of the consensus earnings numbers, if the rebound were to happen in US markets and, Europe markets, which are fairly large centers for Indian IT services, so the earnings could positively surprise on the upside. But valuations again in some of these pockets are high, so we are largely sticking to the large cap names, where we think there is some, still some room.
Would you have a view on the metals pack? That pack is doing well today, but had been a bit of an underperformer post down cycle. Worries about demand from China coming in, and now there are some comments from the Chinese monetary authorities trying to pump prime the economy by easing some of the liquidity conditions. Do you think that could spell some positivity for our metal space, and is that investable?
Right. So metals, in our view, is largely driven by what happens in China. We have seen the Chinese exporters kind of dumping the world market and kind of depressed pricing across in the metal space. So incrementally, some of the news that we are hearing is positive, but there have been quite a few false starts in the past as well. So we are watchful in that sense. So we do have a metal name in our portfolio, but this would not be a great time to enter. Typically these, we want to buy companies which have, either a great group supporting them, or, when their leverage is kind of trending down, or the prices are pretty, in the worst phase, that would be a great time to enter some of these names, which does not seem to be the case now. So we're largely holding on to a position and incrementally watching out how this Chinese commentary translates into the actual execution.
Okay. Well, just wanted your sense on the entire setup for the markets now, Christy. The Nifty has given returns of 19% year to date. The mid caps are up over around 30-odd%. What's your strategy? What are you advising clients? Probably take some profits off the mid caps, or and change and shift their money towards the frontliners, or would you continue probably looking at the mid caps for further gains?
Yeah, so our broadly advice is, we should, to any investor, is we should largely moderate our return expectations from the market. It's been 2 fairly good years in the market, and typically, as the history suggests, there could be some moderation that could be coming. But again, we cannot really get out of the market as such, because, if you kind of miss out, being part of the market, you your returns are not so great in the long term. So strategy is to move away from the pockets which have done extremely well, which includes large and mid cap, and there is some bit of euphoria, move into the large caps. Especially, you would have to look at the portfolio construct very carefully. At least from a value manager point of view, we want to deploy where, there is bulk of value, which remains, in our view, in the financial space. And we are also sitting with fairly sizable chunk of cash as well, roughly around 15%, which we would look to deploy as and when the market corrects. So, advice is a bit of caution and, expectation of return moderation going ahead.
All right, expectation of return moderation with advice of caution. 15% is the cash that you're sitting on. Let's wrap it up with, the consumer space. A lot of people are hoping for rural recovery and thereby showing their proclivity towards, the staples. Just wanted your thoughts on that. Are you looking to back some of the staples? Because falls right in your, not having run and is a large cap sort of thesis.
Yeah, so I think from a staples perspective, looks like the market has priced in a lot of positives that could come, even from a rural recovery point of view. And we're just about hearing some bit of improvement within the rural bucket. But our concern is broadly when you look at the whole staples piece, of course, there are great companies with extremely high return ratios and so on and so forth. But the valuations that they tend to trade at is beyond our comfort zone. So this is a place we would love to own, but at lower valuations. So that remains our chief concern. And we also have to see whether the rural recovery, which is touted about so much, actually plays out. That is also a point to keenly watch out for.
So incremental money, where is it that you're finding valuation comfort right now? If you could give us your top 2 sector overweights, and in that, if you could, probably give us a bunch of names as well without delving into specifics.
Right. So, if you look at the past quarter or 2 quarters, where we have actually deployed is essentially into private sector banks, largely to the top banks, because, there is reasonable comfort on valuation. We know there are certain concerns such as moderation and credit growth, the whole credit to deposit ratio being higher, but we largely see these, themes as transitory. And probably when you're taking a slightly longer term view, most of these banks are in the right place to deliver growth at the right valuation. The other pocket is like we've been incrementally finding opportunities within the life insurer pack. So we have deployed some incremental cash that is there into those. But these are the only places we have largely trimmed our allocation in autos and most of the other sectors.
Just quickly before we let you go, have you looked at the MNC space? The reason I ask is that stocks such as AstraZeneca are doing extremely well today. Very good price action on that counter, and I was just reading about the kind of growth that they're seeing in the Indian market as well. Are those portfolio plays according to you?
Yeah, so not again specific to the name, but within the whole pharma space, we are fair bit deployed in the pharma space. It is, though we are slightly trimming in some of our allocations because, the US, the pricing has continued to surprise us. It continued to be extremely strong, and the India bit is doing what it used to do, fair bit of growth, very steady state growth. So the pharma as an allocation has remained, for quite some time in our portfolios, but incrementally we've been trimming a bit because some of them we think have run up too far ahead.
All right, Christy, thank you so much for joining in and giving us your view on the sectors, your top picks and things to avoid, sitting on 15% cash, preferring large caps to mid caps right now, hoping for some growth to come by, and at the same time liking only the private sector financials and some of the life insurance companies in the very recent past. Take a short break, come back, get you more on the markets and get you some insight into the new market debutants today.
Welcome back. Well, quiet for the markets, but let's shift focus to the market debutants. We have 3 companies which have listed today: Western Carriers, Arcade Developers and Northern Arc, which have made their D-Street debut today. Let's start by covering Western Carriers. It's a logistics player maker, and it was pretty much a subdued debut that they've made. Manglam, tell us more about it, and was this kind of a reaction expected?
Well, some part of it was expected, and I'll tell you the reasons why for Western Carriers. The first one, of course, is that in light of a time where, you have IPOs which are subscribed 60, 70, 80, some even in triple digits, there was a total demand of 30 times its issue price. That isn't to say that there wasn't any demand for it, but it was a lot lesser than what it was for all the other IPOs. The company's raised about 500 crores, 400 crore comes in via fresh issue. It is India's largest private multimodal rail-focused 4PL asset-light logistics company. The market share for both domestic and EXIM volumes are 6 and 2% respectively. They are facilitating multimodal transaction, and of the 400 crore rupees that they will raise, about 165 crores goes into repayment of debt, and capex is another 151 crores itself. Now, here's why the street expected subdued listing this time around. Why? Because one, revenue CAGR of the company has been just about 4.6% in the last 3 years. Metals account for 50% of their revenue, FMCG and pharma, the rest. All these sectors haven't been doing very well in the last 3 years or so itself. And that's reflected in the meager volumes for the company as well. 2.16 lakh was what they did in FY22. That fell to sub 2 lakh in FY23 and is still at around 2.12 lakh itself. And if you look at the financials as well, some things don't tie in. Revenue of FY23 was close to 1600 crores, FY24 1700 crores. Margins have, yes, from FY22 increased from 7% to close to around 8.1% as well, 8.7%. But that hasn't reflected as much in their cash flow from operations. In fact, the debt of the company has increased from about 150 crores in FY22 to 266 crores in FY24. The cash flow from operations is actually down from 30 crores to about 22 odd crores, and receivables have increased from about 59 crores to 136 crores as well. So maybe the street would like some improvement in their financials and the macro improvement going forward, along with some tightening of their working capital and improvement in their balance sheet as well, before perhaps the street sees some merit in Western Carriers.
Okay, all right, Manglam. Thanks very much for that. So that's on Western Carriers, but we have Mumbai-based realty player Arcade Developers, which has seen a strong listing today. Sonal is here to tell us more about it. Sonal.
Well, yes, it is another good listing that we've seen today. The stock listed at a premium of 38% at 175 rupees a share versus the issue price of 128 rupees a share. And this is something which was expected because it saw strong subscription. In fact, it was the most subscribed real estate IPO that we've seen in the last 5 years. And the total subscription or the bids were to the tune of 106 times itself. The promoter holding before this issue was around 80%, and that falls down now to 66.33%. Now, the proceeds, they will be used for development of ongoing and upcoming projects, general corporate purposes, and also funding acquisition of future real estate projects. About the company, as you mentioned, it is a Mumbai-based real estate player, and here the company is both into redevelopment and development projects. In fact, redevelopment is as much as development portfolio for the company, and that is a big opportunity that the company talks about. Their operational updates, they have been increasing volumes. Volumes in FY23 came at 0.19 million square feet. Their collections came at 258 crore rupees, and sales in terms of units increased to 258 units. This compares with lower levels that the company saw in FY22, so there has been a growth that we've seen there. The other thing that worked for Arcade Developers is valuations, because if we go by FY24 numbers, their net asset value, it was the lowest that we've seen in Mumbai real estate players. Remember, the NAV here is high because of the land values and the asset values as well. For Godrej, it is as high as 359. We have Keystone at 157. Suraj Estates at 148. Arcade was just 21 rupees. So the valuations work for them. Yes, there were some risks in terms of some of the collection amount, the cash flows, and also the cost of construction that they have. But looks like Street is looking at the opportunity that they have from redevelopment and also the pricing of the IPO, where the valuations have been much lower than the peers.
All right.
Okay. Okay, all right, Sonal. Thanks very much for that. So that is on Arcade Developers. But back to you, Manglam. Northern Arc is the other one that you're watching out for.
Yep. Last week we had the management here. When the IPO opened this morning, we spoke to them once again post the listing, and they reiterated a couple of things, and that explains why the stock has seen a fair amount of listing. It listed at a 33% premium. Thereafter, it's seen some moderation, still holding with a 20% uptick versus its issue price itself. The key takeaways from what the management said: their CRAR, which was close to around 18%, will increase to 23 to 24% post-capital raising. In fact, they've raised this capital for growth itself. The balance sheet has been growing over 31% over the last 3 years, and the management believes that this is a rate that they can continue to grow at in the future as well. As far as their borrowing is concerned, 20% of that comes in from offshore multilaterals. Their core NIMs are close to around 8.3%. Plus, they have some fee income, placement fees as well. So if you add both of them back as well, you have a total fully loaded net interest margin, as the management calls it, closer to 10% itself. 40% of their exposure is MSME. MFI accounts for 26%, and 27% is consumer loan itself. And the return on assets are over 300 basis points on a fully loaded basis. So key things to track from here on is, will the company continue to grow at 30% plus? What happens to their asset quality? And nearly half of their loans are syndicated. What happens to their own loans is something that we'll be watching out for. In a down cycle, typically 65% of their loans come in from banks, so that may impact their NIMs further positively as well. So those are a bunch of things we'll be tracking.
Okay, all right, Manglam. Thanks very much for that strong debut for Northern Arc. They're up around 20-odd%. But just want to point out that if you are tracking a couple of these stocks on the volume counters, Northern Arc is one of them. But the other one is Vodafone Idea, which is under pressure today as well. So that stock has lost around 30-odd% of its market cap this month itself and is down 2.5% today. So just about tottering at those 10.5 rupee levels for Vodafone Idea. Let's see whether it manages to sustain in double digits or not, but as of now, under pressure for that particular counter. We'll take a break, but Sachitanan Uttekar of Trade Bulls will join in to discuss some trading ideas. Stay tuned.
Welcome back. You're watching us here on Halftime Report. At near record highs, the market continues to consolidate, even though a lot of stocks are moving around in today's trading session. One of them is First Source at the bottom of your screen. But good time to get in, the F&O perspective. Even as the frontline indices are absolutely flat, cues suggest that this consolidation may continue for a bit. Why do I say that? Because if you look at, the broader markets, you look at the advanced decline ratio as well. This is the expiry week. Ahead of that, there is some consolidation. They've been coming closer, and now there are more stocks declining than the number of stocks which are advancing for a brief period. And now those lines have intersected once again. So the street is not fully decided on the way the market goes from here after having seen a record run already and ahead of expiry too. Speaking about expiry, this Thursday we will have the Nifty expiry, and there is a range-bound move which is expected. Put writers at 25,900 extremely active, telling you 25,800 at the lower level would be strong support. But 26,000, which is a psychologically important mark as well. Out there, the call writers are pretty active for a premium of 80 rupees as well, telling you levels upwards of 26,050 to 26,000, almost 26,100 may see some sort of supply coming in for the frontline index. But ahead of the Thursday expiry, we have the Nifty Financial Services expiry today as well. Nifty Financial Services is at 24,920 thereabouts for that index. And you have the 24,900 call and put most active, also have the highest open interest. What's the premium on the 24,900 straddle, which is a call and a put together, close to around 60 rupees, telling you once again that is the 24,850 to 24,950 sort of narrow range that the street is expecting for the Nifty Financial Services expiry as well. That brings us down to all the individual stocks. Remember, we told you on yesterday that RBL Bank may exit F&O ban. Well, one day of being out of F&O ban, it may re-enter F&O ban. Also, Hindustan Copper and Escorts Kubota are seeing a lot of open interest, have crossed the threshold level, so may enter F&O ban if there is no further unwinding from here as well. Also, keep an eye on Nalco and Aarti Industries. Metal stocks are doing extremely well. Nalco is doing a little better there as well. One of the elements could be its potential exit from F&O ban today, and Aarti Industries is the other one. After being in F&O ban for a while, maybe one of those contenders for coming out of F&O ban in today's trading session.
Okay, all right, Manglam. Thanks very much for that. Sachitanan Uttekar joins in now to discuss the technicals of the market. Sachitanan, welcome to the show. Well, quiet day, but not really for the stocks which are moving around. So give us a sense. What's your strategy, both on the index as well as stocks?
Good afternoon, Ekta. Good afternoon, Manglam. I think clearly both the indices are consolidating here, but if you look at the major trend, it still remains strong for Nifty and Nifty Bank as well. For the day, I think the hurdle of 26,000 may not be breached. We may see the Nifty, oscillate within this particular narrow band itself. It is trying to form an elevated base somewhere close to around 25,830, and I think that is a immediate support that we are looking at. So any declines towards this support will again give us a good opportunity to create some long positions here. The overall structure remains healthy until unless the Nifty holds above that 5-day exponential moving average support, which is placed right now at around 25,740 kind of a zone. So until unless this particular level is held on, we may see Nifty eventually swinging towards 26,270 by this Thursday's expiry. When it comes to Nifty Bank, it has been oscillating within the range of 53,800 on the lower side. And I think the headroom is available right up to 54,350. So even here, we are looking at some consolidation for the day, but eventually we may see Nifty Bank also scaling towards 54,350. When we look at stocks, there are two stocks which are looking good from a breakout point of view. The first one is Cummins India. If you look at the overall structure for the last 8 weeks, the stock was consolidating within the narrow range. But if you look at the placement of its weekly RSI, it has given a positive crossover, and the way the options data is placed, it is indicating that the floor is very well set at 3,900. It is getting elevated, and we may see the stock, eventually swinging towards 4,040 levels, and that's why we are recommending building long positions here, keeping a stop loss somewhere close to around 3860 on a closing basis. Eventually, we may see the stock swinging towards 4,040 levels. The second stock on our radar is Maruti. Now, last week we saw it building a very strong base around that 12,500, 12,450 mark. We have already seen a good rally towards 12,800. But the way the data is still shaping up on the weekly scale, we have a diamond pattern formation, and the confirmation of the same has been set right now. So we are looking at an elevated move towards 13,300 eventually. From a trading perspective, we may see a swing towards 13,060, and that's why we are still recommending building long positions here, keeping a stop loss somewhere close to around 12,660 on a closing basis.
All right, take that point. Thank you, Sachi, for joining us and giving us your thoughts on individual stocks once again, and also talking about your view on the indices, some consolidation. Take a short break, come back on the other side. We'll get you our excerpts from our exclusive conversation with JP Morgan Chase's Jamie Dimon. Stay tuned.
Welcome back. Well, veteran banker and JP Morgan Chase's global CEO Jamie Dimon has said that India is doing a lot of right things and has shown optimism about growth prospects. Speaking to Prashant Nair, he said that there is a lot of scope for interest rates to go down in the US, but he also remains worried about the geopolitical tensions. Listen in.
Well, look, going to China, okay, national security, America was overly reliant. That's not being angry at them. You should ask why we didn't do it before, but in terms of rare earths, semiconductors, penicillin, ingredients for pharmaceuticals, obviously every nation look at it and say we can't rely on someone who might one day be an adversary. That doesn't make them an adversary today for supply. Just like JP Morgan's always have multiple diverse supply chains, we don't rely on anything. The second one is around disagreements around policy, like if countries are aiding and abetting industries to dominate global industry and beggar thy neighbor, well, that's not going to work either. So you're going to have people, they're going to be hard fought. It's not going to cause deglobalization, but it's important that countries do that. And so, and it's just starting. It would take years. There's semiconductor, you're talking about 5, 10, 15 years. So even if it's going to take place, it's going to take a long time. But companies are doing it on things like iPhone. I know iPhone production. So some things can move quick. Some will take years. Huge opportunity for China. I mean, for India. A huge opportunity for India. People call it the China plus one strategy now, that companies that relied solely on China are going to look at India, Vietnam, Malaysia, Indonesia, etc.
We've got US elections, and I think one thing which both Democrats and Republicans agree on is China. You'd agree with that. I mean, in that sense, what's happening is in a way irreversible. The break in relations, sort of a Cold War.
I think you have to be very specific in this one. I think national security, everyone's going to do. Unfair trade, everyone's going to do. I think because of the Ukraine, the terrorism in Israel, Russia, Iran aiding and abetting, China's kind of on the other side of America in that one. So that's causing a lot of the tension. I think the better thing to do is get fully engaged, which they've done, our government, to try to protect ourselves in national security, unfair trade. And yeah, I think if the war goes on, yeah, there will be contentious issues between the countries, far more contentious because of that. So both sides, I think, will be fully engaged. Both sides are going to be tough. But I don't think either side is talking about disconnecting.
Let's talk about the big event from last week, which is interest rates coming down, the Fed cutting by 50 basis points. Do you think it was a bit excessive, given the fact that GDP is expected to grow at 3%, the stock markets are at all-time highs? I mean, there's no issue with credit spreads, etc. Indicators are all pretty good, and you get a 50 basis point cut. What do you make of it?
I think it's a lot more ink than it deserves. I think they raised rates to 5 very quickly. They were a little late, which they acknowledged. They raised it to 5. The economy is slowing down, inflation is coming down, and relative to inflation, even if inflation is 3%, the 5 is maybe a little bit too high. So they made a big step to get it close to what they think it might be. They've got plenty of room to go down, and hopefully we'll continue to exhibit growth with inflation coming down. I'm a little more skeptical than other people about that, but it is happening, and they're just reflecting reality.
You've been cautious in the past about prospects and said, well, one has to be prepared for things going wrong. Are you a little more positive now? I mean, this is not a cut when you're facing a recession or things are looking weak. It's like a happy cut. So, I mean, are you a little more...
So my caution is all geopolitics, which may determine the state of the economy. But it's really the geopolitics that these things, they're getting worse, they're not getting better. There's chance for accidents in energy supply. God knows other countries getting involved. You have a lot of war taking place right now. You have American warships being attacked almost every day in the Red Seas. That's my biggest caution. The economy fluctuates. I don't worry that much about the fluctuation of the economy. And obviously the Federal Reserve will try to do its job to moderate the vicissitudes of the economy, but we are spending a lot of money. And in my view, that spending the money causes growth. It also causes inflation. And whether it all moderates, I think it's true for countries around the world. We got to really think through how much debt countries can put on before it causes a real problem. So I'm long-term optimist. Short run, I'm a little more skeptical than other people that everything's going to be great. Markets are pricing things like they're going to be great. I'm putting me on the cautious side of that one.
Right. I mean, rising interest rates did not hurt markets. Will falling interest rates be an impetus? I mean, can they be a further impetus?
Yeah. Again, so when you talk about rising, things are, sometimes history rhymes, but it's not always the same. I think when rates went from 0 to 2.5, that was barely rising rates. That's just kind of normalization. And we had very strong growth coming out of COVID, so 5% was probably needed to slow things down just a little bit. Yeah, underneath the rate, there's a real economy. No one knows what that real economy is going to do next year. No one. And so I don't look at it like, they're panicking to, maybe the economy's get stronger, maybe it's going to get weaker. And so they're trying to remember they're reacting to data they see today. And then you can try to predict what the data is going to be a year from now. I think there's more underlying inflation because of things like the green economy, fiscal spending, remilitarization of the world, demographics. Those things will drive inflation down the road. And even AI, in my view, right now it's a little inflationary because we're all adding a lot of talent around data. It's not, the deflationary part may happen, but that may be several years down the road. Yeah.
Right. You are, when you say you are a bit more skeptical, is that the economy you're skeptical about, or markets and what they're pricing in?
Both.
Both.
I think the stock markets and the bond markets are pricing in a soft landing. Okay. But you also look at the stock markets are generally very high, and bond spreads are very low. And that's kind of Goldilocks, and that may very well happen. I mean, I'm hoping for that. I just give it a lower odds than the market does.
Of that happening?
Yeah.
Welcome back. There is no major movement in the frontline indices. In fact, it's absolutely flat as can be, though we are seeing some traction in a lot of these stocks from the broader markets itself. So a bunch of them actually at the high point of trade. We would see, Tata Steel doing fairly well. It's moved to the higher end of today's trading range so far. In fact, it's up closer to 4%, closing in on that 160 mark. Also, we have UPL, which is seeing some traction. Off the lows, it's recovered about 3% moving higher. M&M is the other one from the frontline indices, which is seeing some up move as well. But one of the stocks on our radar is GMR Power, because a brokerage has initiated coverage with a buy call on the stock. What is the target price? What is the rationale? What is the brokerage? Vivek joins in with all those details. The stock locked in a 5% upper circuit. Vivek.
Well, that's right. Very interesting note. Today, MK has initiated coverage on GMR Power and Urban Infra. They have a buy rating on the stock and they have a target price of close to 180 rupees a share, indicating significant upside. What they're saying is that the core thermal assets of the company currently are doing quite well. They have almost 1650 megawatt of thermal assets and it's near optimal performance as per MK. Along with that, they believe that the key triggers going forward are number one, coal tabs for the thermal power plant. The company already has PPAs to the tune of almost 90% of its installed capacity, and also debt, which was earlier concerned as far as the entire GMR group is concerned, is now improving significantly. Remember also the company has a hydropower asset that is 180 megawatt Bajoli wholly hydropower asset. They believe that too has largely stabilized. Along with that, thermal power, hydropower, and along with that, there's also the smart metering aspect. The company has almost 7.5 million smart metering installation contract, and that has a significant opportunity as per MK. This opportunity is with Bosch. Also remember the company, MK sales, the company now has a clear focus on deleveraging on the back of strong operating cash flows. Deleveraging has been led, number one, by the conversion of FCCBs into equity, and also the handover of the road asset that was earlier a drag. Now, along with that, what they're saying is that they expect the company's consolidated net debt to drop by almost 4,000 crore to 9,000 crore in FY25 itself. On the back of that, they see significant upside potential led by incremental smart meter contracts, monetization, and also settlement of various disputes which they believe can provide sizable optional value. On the back of that, GMR Power and Infra, remember the stock has already done very well, but MK sees further upside even from current levels.
Okay, all right, Vivek, thanks very much for that. So that's on GMR. But I'm looking at AstraZeneca today. That stock is really active on the upside. The stock is up around 10 to 11 odd %. Now, the news with regards to them is that they have got the CDSCO nod to sell and distribute Imfinzi, which is basically a cancer drug, which they are already selling for non-small cell and small cell lung cancer in India. But now they've got an additional indication approval from the government to sell this drug for another additional indication in cancer. Now, currently, they are the 6th largest oncology brand in the country, this particular drug is, and they've said that it's demonstrated robust growth across lung indications in FY24. The value of the drug in FY24 was around 200 odd crores. Now, AstraZeneca has also said that the oncology business as a whole forms around 62% of their sales in India. They also have other very important drugs in their portfolio. So, for example, Tagrisso is used for indications in oncology, and it did around 320 crores in terms of sales in FY24. They've launched Inheritu, which is also a cancer drug. It's used to treat breast cancer in Jan 2024, and it was in fact given breakthrough designation by the US FDA. Other triggers for AstraZeneca include that they've partnered with Mankind Pharma to expand their access for asthma patients in India. They've forayed into the rare diseases segment. They're looking to exit their manufacturing site in Bangalore in due course. The company says that they will strive towards their ambition of being a lead specialist in certain disease areas in FY25. If you look at it, FY24 revenue was up around 29%. EPS was up around 63% for AstraZeneca.
All right, so that's about AstraZeneca doing extremely well in today's trading session, a big jump in the EPS as well. And we are seeing a bunch of traction in a lot of the other cash stocks as well as they move higher. Ticker team alerting you about that. Take a short break, come back, focus on the commodity space. Manisha Gupta joins in, and with her today would be Peter Maguire, who's the CEO of XM Australia on all things commodities.
Welcome back, and joining us on the show now is Peter McQuay. He's CEO at XM Australia. Peter, hi. Another new day and another new all-time high for gold prices at $26.35 an ounce now. Where do you see prices going forward from here?
I've got to laugh because it just seems onward and upward. We've been following this for a long time together, and at the start of the year, you're running at that just over 2. This time last year, you were at 1,800, and here you are at 26.30, 26.50. I mean, it's just got so much momentum. you've got to say, is 27 achievable by the end of the month? I think it probably is. You know, you've got 6 days to go, and it just seems to have tremendous momentum at the moment, and that may be coupled with what happened in China. So I think it's onward and upward, and yeah, 3,000 is probably the target by end of year. Everyone's got their hands saying that, so it's pretty hard to go against the grain, Manisha.
I know those are some numbers, and we continue to look at newer highs coming for gold. You talked about China, Peter, and well, yes, China has promised a lot in coming few days. They haven't given a timeline, but then they've talked about housing markets. We've seen reverse repo for 7 days and 14 days also already being worked upon. What's your sense on how much, where, when China would do? We have, of course, seen the metal prices already react to this.
Exactly. I mean, you know, when you look at the likes of tin, aluminium, nickel, you know, of course, copper, they've all had a nice rally to the upside, and they're fairly strong at the moment when you're thinking where they have been, and, you know, that move to the upside, you've got, you know, the best part of 95.50 for copper. As far as a timeline, Manisha, are they a couple of things? Is it going to stimulate, and it was a pretty aggressive move as far as the interpretation from the property sector. Secondly, it's got to be, you know, you've got to look at a fiscal side as well. Thirdly, it is a fairly big bazooka. And it's from a timeline, when is it going to be introduced? I'm sure it'll be, but they've got to get it moving. And are they still going to hit their 5% target by end of year as far as growth numbers? You got the CSI today was up the best part of 4.1, and it's still got probably a little bit of movement left. Shanghai's up 4.1 as well. CSI 300, 4.3%, and HS China Enterprise ENT up nearly 5%, Manisha. So it's been interpreted well from China's, equity market.
Oh, well, absolutely. The underlying commodity and the equity markets all surging up today with what China can do perhaps going forward. Peter, if you had to make a portfolio today, what would you buy in? Gold, as you said, is going to be quite bullish between silver and all of these base metal prices. Where do you see more momentum coming in?
You can't move away from silver and gold, Manisha. I think that's where the focus has got to be. You've got a US dollar index sitting just on 101. It's about 100.99 for US dollar index. And if they drop at 50 basis points on the 7th of November, then that's going to, I think, take a little bit more steam out of that US dollar. And that's what everyone's suggesting may happen, because there's no cut in October. So you've only got November and December, and they want to get 125 basis points. So somewhere you've got to have a 50. So if you hit another 50, that could really crush that US dollar further to as far as softness. And that's going to be, I think, the horsepower that's going to, another round of horsepower that's going to drive, I think, the attractiveness of gold. I just listened to previously what Jamie was saying, Jamie Dimon, and, you're talking geopolitically as well as far as military and what's happening with US ships in the Red Sea and around that area. So there could be geopolitical tensions again going to drive that further forward, Manisha.
So within metals, then, Peter, whether it's going to be copper, aluminum, zinc, tin, iron ore, where are you putting your money in?
Well, iron ore's been a real flat one, and maybe that's going to bounce because it's probably been oversold, so you can't take your eyes off that. We've got to see how it washes across naturally to a $5.3 trillion property market, Manisha. So if iron ore's possibly a bounce, and, we're going to see 10,000 for copper. You're at $450 away. It seems to have, again, aggressive momentum to the upside. So this could be just the I suppose, the stimulus required to really kickstart some of those metals along. I think, one in, all in. It's pretty hard to go against, you can't be too, project management around this and just try and pick one or two. I think that's going to, the rising tide's going to lift all boats.
Oh, well, absolutely. If China comes up with what it's promising, then it's all money in for metals. We get that point there, Peter. Thank you, as always, for joining in and talking all things that is metals. But with that, it's a wrap on Halftime Report. Business Crunch will take all the action ahead.